Trading terminologies or common trading terms that you must know if you are new to trading. Bull market. When the prices in a market are generally rising, it is called a bull market. Or when the market is going up, we call it a bull market. Bear market is the opposite of the bull market. When the market is falling or market is going down, we call it a bear market. Bid is the amount that we are willing to pay for an asset. Ask is the price at which you are willing to sell an asset. And spread is the difference between bid and ask price. On the screen we can see various bid price and ask price are mentioned. Euro USD, USD, Euro, USD, Japanese yen. So you can see bid Euro USD bid price is 1.3350 and ask price is 1.3354. So what is the spread? Spread is 0.030. In simple words, if bid price is 1 and ask price is 3, then the spread would be 2. Market order is a price at which we execute an order. It is advisable to avoid market order because it may not be favorable always. To get a better price, it is always advisable to place the order at limit price. While placing an order, we always get the option of placing the order at the market price or the limit price. If possible, go for limit price only. But sometimes limit price is not available. At that point of time, as we have no other option, that we need to go for market order. Anyways, what is limit order? Limit order, an order to sell asset above a set price or buy asset below a set price, is called a limit order. You should always use limit orders to trade shares. Limit order is the favorable order or for all the traders. It is a price or it is a better price at which you are willing to buy an asset or you are willing to sell an asset. It is advisable to go for limit orders if possible. And what is liquidity? Liquidity refers to how easily an asset can be sold off. An asset that can be sold off quickly, that is, has high trade volume, is said to be highly liquid. If you're day trading or if you're into day trading or swing trading also, try to go for liquid shares or liquid currency pairs. Liquidity is very essential and very important thing while going for a trade, because suppose you have purchased an asset and you want to sell the asset at particular point of time, but if at that point of time when you want to sell you don't find a seller, then you will be in trouble. So if there is liquidity, then there is no problem of buyers and sellers, you'll always find someone. But if the market is illiquid or the currency pair or the stock is illiquid, then there will be problem to place the order. And the spread will also be higher. Suppose you want to sell at $5 and someone is sitting at $2. There is a difference of $3, but as the market is illiquid, you have no other option. So as a result, you are forced to sell it at $2. But in a liquid market, the difference will be very low. Suppose you want to sell at $5 and you'll find someone at 4.95 or maybe $5. So always go for liquid market to avoid complications. With experience, you will come to know the importance of liquidity much clearly, and I'll be also explaining the importance of liquidity in later lessons. So that's all. Thank you so much.